Hey guys, welcome to the second video of the Fin module where we'll be talking about presentation of financial statements. So again, similar to chapter 1 in most subjects, it's not the most interesting chapter and it is a little bit hard to, explain than the other more specific topics such as revenue, income tax, etc. going forward. Just before we begin, just make sure you've got chapter 2 notes downloaded in front of you, similar to what I've got on the screen, just so you can scroll through it and read some of the notes in more detail. As some of the topics I will be skimming through a little bit quicker, particularly the ones that I don't think are as relevant. Anyway, let's just jump right into it. And as I said before, this particular chapter, a lot of it is probably more beneficial to learn from practical example questions, actually preparing a statement of financial position or a statement of profit and loss and other comprehensive income. But what I'll do for this is probably go through on a high level each of these, and then we might go through some example questions later on in a separate video as well. So just jumping into it. So we mentioned in the previous video that a complete set of financial statements contains a few different things. A statement of financial position, aka a balance sheet, a statement of profit and loss and other comprehensive income, which is basically just a P&L. A statement of other changes in equity, which is just your movement in equity. Your statement of cash flow, which is your movement in cash. Your notes to each of those statements and comparative information for each of those statements, i.e. current year financials and also previous year financials. So let's jump in straight away and go to statement of financial position. So this is basically your balance sheet item. And the way that we'll work through this is that you'll have your face items on the statement of financial position, so your categories, and then what you'll have in a set of financial statements is you'll have notes, and you'll have to follow your note through, so you'll just have a number like note 2, note 3. You have to follow that through to the end of the financial statements, and that's where it breaks down each of those categories into a little bit more detail. So this is just what the CSG outlines as what you'd expect a statement of financial position to look like. And they've also interestingly brought here the relevant chapter in the CSG that will talk about each of these in a bit more detail. And also the IAS paragraph in which that topic relates to. So I don't think I've actually specifically used this as a resource in the final exam, but it is good high-level information to kind of know about. So you'll see that the statement of financial position breaks it down between current and non-current assets, and it does the same for current liabilities and non-current liabilities. They sums both of those till we get to net assets, which is the difference between total assets and total liabilities, and that should equal your shareholders' equity. So a good check to make sure that the maths is adding up on your balance sheet or your statement of financial position is that your net assets equals the sum of your shareholders' equity. If it does, perfect. If it doesn't, something's wrong. And then what they'll do down here is they'll attribute equity attributable to the owners of the entity and equity attributable to the non-controlling interest. So we'll talk about that towards the end of the module, but this is basically talking about non-controlling interest is the minority shareholders. So what we'll do is we'll move on from this. As long as you understand on a high level what that means, we'll get onto that in Unit 16. Now, in terms of how you allocate assets between current and non-current, as you can see up and above, there's specific rules in IAS 1 in how those are defined. So there's 3 definitions for current assets. So cash or cash equivalent. So that's deemed by IAS 1 as always being current. And it makes sense because cash you can liquidate almost instantly. It's the universal form of currency. Number 2 is it's held for trading. For example, trading stock or inventory. They're saying that might not be realizable under the normal rules, but under IAS we're deeming that that's going to turn over more quickly than 12 months. So that's always going to be categorized as a current asset. The final definition is probably the one you're most familiar with, is that it expects to realize within 12 months or normal operating cycle. So the operating cycle can actually be longer or shorter as long as your business industry, that good turns over in one operating period, or 12 months. That's default if that doesn't exist. Now, it's similar for current liabilities. So no unconditional right to defer settlement beyond 12 months. If that's the case, then it's also going to be current. And it makes sense because if you can defer settlement or defer how much you have to pay for the liability beyond 12 months, for example, if the legal suit is, conditional for, you might get a deferment to 24 months, then it's no longer a current liability. Similar to current assets, held for trading is also a current liability as well, if the liability is on a trading account. And the final one, similar to current assets, is due within 12 months or expected to settle within 12 months or within a normal operating cycle. So it's basically just the exact inverse of assets, just replacing assets with liabilities, and you've got your three definitions, except cash is replaced with no unconditional right to defer settlement beyond 12 months. So kind of simple stuff. So let's move on to the statement of profit and loss and other comprehensive income. So in layman's terms, this is a P&L. So it breaks it down in terms of revenue, i.e. money coming in. Then you've got your cost of sale. So you can classify these expenses by function or nature. And we'll talk about that a little bit later as well. So cost of sales is usually the items that you're using. For example, you might be selling inventory over the counter, that's your cost of sales. The net difference between those is equals gross profit. So gross profit equals revenue minus cost of sales. You then add in your other income. So this is income that's not part of your normal trading revenue. For example, you might have disposed of a vehicle or something like that. Selling and distribution expenses. So this one, as I mentioned before, you can classify expenses by function or nature. So they've obviously made an election as to one of those, but you can also just categorize them individually by different expense type items. So here we've got administrative expenses, R&D, other expenses. Now this is share of profit from associates accounted for using the equity method of accounting. So this is an interesting one. So this is basically saying if you own part of a joint venture, for example, you only own 20% of a joint venture, you report all of the profit of that entity above here at 100%. And then the difference between what you own and what they own, i.e. the 80%, is reported down here. But it's only reported at a net profit level. It's not reported at a revenue level, so you don't really get the breakdown between those. And then we talk about finance costs and finance income. So that's things like interest and borrowing expenses, etc. Then we get to profit before tax, and then we get to income tax expense, and then we get to profit for the year from continuing operation. Now, if we scroll down, we're continuing from above. So profit for the year, we got profit for the year for the period attributable to owners of the parent entity and non-controlling interest. So this is where you split it out similar to above between the non-controlling interest, i.e. the minority shareholders, and who actually owns the parent entity. So it's a little bit complicated, but we'll talk about that much later in the chapter. As long as you understand on a high level, everything's kind of grouped together at the beginning till you get to profit level. So even if you own 20% of an entity, you gross it up to 100% and you include it in here. Then once you get to after the profit line, it splits out the profit between the non-controlling interest or the minority shareholders, say for example the 20% owners, and the majority, so the 80% for example. So that's how you split up profit. It's a little bit complicated. Then you get to a thing called other comprehensive income, and that's basically the difference between a P&L and a SPLOCI, statement of profit and loss and other comprehensive income. So other comprehensive income is everything that you probably wouldn't expect to go in a P&L. It's generally things that you don't receive cash for. It's just an accounting journal, but it has to go on the P&L somewhere because it does reflect either a future profit, for example, or a valuation of an asset or something similar. So this one's probably the only tricky part to it. But most people, most shareholders, for example, only stop reading up to the point where it says profit for the year, which is this line item here and which part it's attributed to. So things that go in here, for example, is revaluation of land and buildings. So for example, you bought a building for $1 million and now you got a market revaluation done, and they told you the building's worth $2 million. So the journal for that one's going to be debit asset $1 million to increase the base price or the cost price in your balance sheet, and the other side is going to be credit profit and loss bracket other comprehensive income. So that actually goes in here. Some other things that would go in here that would not be classified to the P&L that would go in the OCI is income tax on items that will not be reclassified. Okay, so the next section that we're going to talk about still under the other comprehensive income, but it's items that may be reclassified to profit and loss. So basically, they're currently not in the profit and loss, but they may be reclassified to profit and loss at a later point in time. So the OCI is actually split up between those two categories. And you can see over here on the side of the notes, when you're writing your exam, you actually know which headers to include and which ones to not include. So for example, include this heading when you're writing out your SPL OCI in your exam. Okay, so continuing on with items that may be reclassified to profit and loss in future. So foreign currency translation of overseas subsidiaries. So this is Forex items. Fair value through other comprehensive investment income investments. So we'll talk about that later in chapter 9. Keep in mind, if this doesn't really make sense to you at this point, don't worry too much. Just try and remember these, or alternatively just print it out and keep it with you so you can just tick it off when you're in an exam. Do I need to include this in OCI instead of the actual P&L? So this is a type of investment that's actually specified that you report gains through this section. Don't worry about it for now, we'll touch on it later. Cash flow hedging, again, we'll touch on that in financial instruments, unit 9. And share of other comprehensive income from other associates accounted for using the equity method. Again, that might sound confusing. Don't worry, just remember the name. We'll touch on it in unit 17 right at the end. And the last item is income tax on items that may or may not be classified. So you can see that differentiates from this point up here, where income tax on items that will definitely not be reclassified. So we'll talk about that a bit later, but generally they specify, because it's not the tax module, they can't expect you to know this. They will specify whether or not it will or won't be reclassified. So, and then you get to your total line items, and then again you split them out between owners of the parent entity and non-controlling interests. So, yes, that was confusing. Don't worry, don't get stressed out by that. Just use this as a template in your exam. Just write out each of these headers in bold, and then you can review back to your question and kind of put them in as you identify them. So we'll go through some example questions later so you can see how that works. Okay, so moving on to the next statement, so the statement of changes in equity. So this one basically tells you the movement between opening equity and closing equity. For example, movement in share capital, retained earnings, and other OCI items which are impacting equity. For example, and we'll touch on those later as well. So foreign currency translation, cash flow, hedge reserve, fair value through other comprehensive reserve, revaluation surplus, share-based payment reserve. So again, this sounds confusing, but you will get the journals. I'll give you a really good template for using accounting journals, and it'll tell you exactly whether you need to add this into the cash flow hedge reserve or not, for example. So it's actually quite simple once you get that template. Okay, so here's an example of a statement of changes in equity. This is pretty much what it looks like. And in exam questions, you will be asked to draw up something like this. You can just use this as a template. Also, you can use the journal guide that I will give you prior to your exam, which makes it super easy. You just fill in these, and we'll touch on that later, but this is basically how it works. So you start off with your opening balance. You add your profit for your year because that goes into retained earnings, and you can see that going in there. Then you add in your OCI components, so all your journal revaluations and things like that, which I'll give you the journals for later. That gets you to total, and then total comprehensive income. And then you also got to reflect any amounts paid out through dividends. And then you total that, and you get your balance of owner's equity. So not too tricky once you do some examples. Okay, so the next statement we're going to look at is the statement of cash flows. So this is basically tells you how a company's cash is earned and spent during a particular financial period. And it's actually one of the most important reports that companies rely on, because if you're not aware that how a company is spending its money, it's often one of the most common ways that a company can go into liquidation is because it hasn't managed its cash flows effectively. And it also lets you know whether you need to take out external financing, where the money is being spent unnecessarily or held up in the business, which could be used for better purposes in the business. So it's actually a very important report. In the fin module, it's not as important. It's more just understanding a few different things, and you might be requested to actually prepare a statement of cash flows. So the way a statement of cash flows actually allocates movements is into one of three categories. So it's either operating, investing, or financing. So that's probably the main thing to know. And they've also got a definition of cash and cash equivalents, but you should all really know what that is. So what you'll do is you'll start off with your opening cash, and then you'll categorize movements in operating, movements in investing, movements in financing, and the sum of those should equal to your closing cash balance. Okay, so just understanding what kind of things fall into which category. So operating is things to do with the normal operations of the business. So payments to suppliers and employees, so wages, purchasing stock, etc. all falls under operating. Receipts from customers, so that's your sales, income tax paid. So just it's the easiest one to kind of complete. It's anything to do with the daily operations of the business. Investing is to do with PP&E. So anything that you've used to acquire PP&E or even sell PP&E, if you get cash back from selling a motor vehicle, for example. If you've got investments, for example, you've got investment in shares or investment in a property, this will all be in the investing account, as well as interest and dividends received and cash loans, anything to do with loans relating to investment activities. Now the last one is financing. So this is to do with share issues, share buybacks, borrowings, so debt, dividends, and finance leases. So basically anything to do with the financing / equity structure of the business. So to recap, it's either operating, so think everyday business, investing, think of buying capex and other equipment, and the last one is financing, so this is to do with the debt equity structure of the business. And here's just some minor points about how there are just some disclosures to the cash flow must be prepared, and these will just be in the notes to the cash flow at the end. Again, most likely these won't come up in an exam question. The most likely type of exam question will be prepare a statement of profit and loss and other comprehensive income, prepare a statement of financial position, prepare a statement of cash flow. And it's really just allocating each of those numbers that they give you in the question to the right category, making sure that you've got the right date, the right company name, the right categories, that you've allocated it correctly, that you've totaled it correctly, that you haven't missed any of these items in here. It's really not that hard. It's really just making sure you don't make any simple mistakes in the exam, stupid mistakes. So really it's just being calm and basically following the template that I'll give you in your study pack. So these type of questions aren't really too hard. There's some methods of preparing statement of cash flows. So the CSG goes into a lot of detail about this. I'm going to tell you now that you probably don't need this as much in as much detail, especially when you're going to follow our template guide. It's in here anyway if you want to read through it, but I don't think it's that useful, to be honest. So these are just general stuff from the CSG, which is probably more practical for when you're actually in the workforce and you actually want to read back into your CSG notes when you're preparing it in real life. But in terms of preparing for the exams, probably not that useful. Now, we're going to go into the next section, which is actually quite important, and that's talking about accounting policies and change in accounting estimates and errors. So that's basically figuring out whether we're going to how to represent any changes in accounting estimates and errors. How does that reflect in the financial statements? And you do tend to get some exam questions on this. Okay, so for the first section is talking about if you have a change in accounting policy. So entities should apply accounting policies consistently for each accounting period or similar transactions. So that makes sense because you want the same policy year on year so you can base your financial decisions based on the same financial information. For example, if one year they've changed their depreciation policy and this year it's different, and you're basing it based on, say, net profit of the business, your investment decision, how can you be relying that what you're making on is same year on year? You can't. So basically there's rules around this in IAS 8, and it's saying that an entity can only change its accounting policies if the change is A, required by IFRS, or 2, the results in the FinStats provide more reliable and more relevant information. So basically, once you choose one policy, you can't change it unless it's going to result in more reliable information or it's required by IFRS. An example of one required by IFRS is the recent lease standard coming out 2019. That's required by all companies, and it actually tells you to retrospectively adjust your accounting policies. In other words, it means it wants you to go back and prepare last year's as if that standard was implemented. So this is what is happening with the latest one. So it may need to be applied retrospectively, i.e. adjust opening balance of each affected component of equity for earliest comparative period presented and other comparative amounts disclosed. Again, this is probably too much detail for probably what you need. So here it's accounting policies versus accounting estimates. So this is explaining the difference between the two. So a policy is a principle by which amounts are recognized and measured. For example, it's the accounting policy could be the depreciation method. It's the method we've used to recognize and measure depreciation of a particular asset over time. Accounting estimate, on the other hand, is something different. It's where, and there is a level of estimate in this. There's a level of judgment in this. For example, if you are estimating an asset's effective life, like how long you're going to use that asset, that's an accounting estimate. A policy will be applying diminishing depreciation on that asset, but judging how long that useful life is, that's an estimate. So there's examples of accounting estimates down here. So bad debts, for example, estimating which debts need to be written off. Same with inventory, which inventory needs to be written off. The fair value of financial assets or financial liabilities, because this can change year on year and everyone might have a slightly different opinion of what fair value is. Useful life of depreciable assets, which we just talked about then, warranty obligations. So again, this comes down to estimate. So a change in accounting estimates is a little bit different to a change in accounting policy. So accounting policies is usually retrospective. A change in accounting estimate is applied prospectively, so future periods are changed. So it's impacting the statement of profit and loss and OCI in the period of change, and the statement of financial position in the period of change. Okay, so we've talked about policies versus accounting estimates. What about prior period errors? So prior period errors is where a mistake was actually made because of either the wrong estimate or judgment was used and was not appropriate at the time, versus a change in accounting estimate. This is the other option. So this is where new information is available that was not available at the time of the financial statements. So an error is a mistake. Change in accounting estimate is new information is changing the calculation. So the original calculation wasn't incorrect based on the original information, it's just that new information has come in. So error, where a mistake was made, needs to be adjusted retrospectively in the past. However, in comparatives, if an error has occurred to earlier periods, opening balances, it must be changed as early as possible. If it was a change in accounting estimate, however, it can be changed prospectively. So here's a good table to use to outline the detail or outline the changes for each different specific issue. So for example, change in accounting issue. If it's the first time application of the standard, for example, the new lease coming in, just follow whatever the lease says. If it doesn't say, it's retrospective. If it's a voluntary change in accounting policy, it's retrospective, i.e. in the past. If it's an error and it's material, you have to change it retrospectively, so change all of the previous numbers. If it's immaterial, it's not a huge amount, they're saying change it prospectively, so change this year and next year going forward. And the last part is change in accounting estimate. So this is new information has come in, it's not because of a mistake. you want to change this prospectively, so change this year and next year going forward. So this table is really useful. I use this table in exam questions, so just keep that in mind. So this is just a summary of what we discussed above. Again, if you prefer the flowchart method of understanding information, please read through it. But I think I've summarized everything that's in this table. You don't necessarily need to read through it if you understand it. So the last part that we're going to talk about, I believe, is related party disclosures. So this is important in real life because often, especially in audits, related parties are a key audit risk because they tend to relate to contracts which have inflated price or inflated salaries or anything above market value. It's also a risk of fraud. So it's very important that these items are disclosed in the financial statements. So this is a requirement under IAS 24 that related party relationships must be disclosed. So this is basically a table which outlines the difference between or identifies what is a related party. So basically just read through this table. This is where a related party does exist, a relationship does exist, and here's where it doesn't. So it's basically any close family member to someone who has control of the entity or influence over the entity. For example, someone on the board, any one of their close family members is a related party disclosure. So the wife of the chairman couldn't have a external contract as a payroll provider without disclosing this because shareholders need to be aware of this. They need to be able to check this independently that it's not above market rate. Any key managers of the reporting entity or parent entity itself, parent entity, subsidiaries, associates or joint ventures, or a management entity that provides key management personnel services to the reporting entity. So where a related party disclosure is not required is two entities simply because they have a common director / key manager. So it's quite common to have a director on the boards of two different companies. That's okay. It doesn't need to be disclosed. Two joint ventures simply because they share joint control of a joint venture. So that's okay. Providers of finance like banks, unions, utilities, customers, suppliers, franchises, distributors. So really just these 2 points you have to remember. You have to watch out for that they're not related party. So related director / manager or 2 key joint ventures simply because they share joint control. Okay, so here's an example here. So entity A is this little company here who owns 100% of entity. Entity A is 100% owned by Mr. B, who also owns 100% of entity C. Entities A's directors, Mrs. D and Mrs. E. Mrs. D is also a director of entity F, and entity A, so she's a director of both of these companies, and entity H each own and control 50% of a joint venture. So keeping in mind what we said above about do not exist, these are the 2 easiest ones to look out for. 2 entities simply because they have a common direct manager. So entity F is not a related. There does not need to be a related party disclosure for Mrs. D simply because of the fact that she's a common director of entity F and entity A. The other point is around entity H, because just because it shares joint control of entity G with entity A doesn't necessarily make it a related party. You can see those 2 points down there below. However, all other ones, and Mr. B as he has control of entity A, are related party disclosures. So Mr. B because he has control of entity A, entity C because he controls both of them. So if entity C had a management contract with entity A, there would need to be a related party disclosure. Mrs. D as she is a member of the key management personnel. So for example, if Mrs. D had a management contract with entity A as for example, a payroll provider, that would need to be a related party disclosure. Mr. E, same as Mrs. D, and entity G as it is a joint venture of entity A. But just to reinforce the first point, just because she is a director of that and that does not mean this is a related party of that. And same for entity H does not mean it's a related party of entity A. So I think that pretty much covers related party disclosures. Discontinued operations. So this is one of the last sections. So discontinued operations. So this is basically where an entity has been disposed of or it's classified as held for sale. So it could be a large business which is no longer going to continue. So these actually need to be presented separately. And if you remember earlier on the statement of profit and loss, this was actually disclosed separately. Profit for the year from continuing operations and profit and loss for the year from discontinued operations. So we actually split out those two in the SPLOCI. Okay, so the last point we've got here, just to scroll down. So related party transaction, we covered this. Discontinued. So we got to disclose these separately in the P&L. That's probably the only main item. And this is the last topic, but it is an important topic, and it is a question that comes out quite often in 2 to 4 markers. So it's events after the reporting period. For example, there might have been a fire straight after we've released the financial statements, but before they've been issued. Do we need to go back and adjust them? Or it could have been a lawsuit where conditions have changed. Do we need to go back and change them? So there's 2 types of events. There's adjusting events and non-adjusting events. So events occurring after reporting date. So let's start off with adjusting events. So provides evidence of conditions that existed at end of reporting period. Adjusting event. For example, there may have been a lawsuit in, say, 29th of June, right before the reporting period finished. They finalized the financial statements, and then say in July or August, there has been a serious change in the lawsuit. Previously, what we thought was unlikely to go ahead as settlement is now looking like a $10 million settlement for the company. We need to go back and adjust the financial statements for this liability, as it's an adjusting event. That's IAS 10. So this is the non-adjusting events. This is indicative conditions that arose after reporting date. For example, a fire might have happened in August. There was no indication that this was going to happen at the time of financial reporting. This is a non-adjusting event. You just need to disclose the nature of financial effect of material non-adjusting events. If it's immaterial, for example, the fire didn't destroy any property equipment and there's maybe an insurance premium of $10,000. In a large company, that wouldn't be a material, therefore we wouldn't even need to disclose it. If the fire destroyed the whole factory and there's a going concern issue, we would need to disclose that. There's some examples in these notes, but that's pretty much it for Chapter 2, a little bit longer than Chapter 1. Thank you for watching. Don't forget to watch the next video in the next section, which will be on revenue. Thank you.